the good news is people want to be in DFW. They like the way that this is a landlord-friendly state. They like the business environment here. They like the cost of living here. Population growth, job growth, companies are relocating here.
Ladies and gentlemen, welcome back to another episode of Keeping It Real Estate. I'm your co-host, Dan Breezy, and today we have Nick Fluellen joining us on the show. I've known Nick for about 6 years now, and his team actually sold us our first ever DFW multifamily asset, which was one of our best performers to date. Nick is a multifamily broker with Marcus and Millichap and runs an incredible team on the brokerage side with over 440 transactions totaling $3.1 billion in value. With that said, Nick, welcome to the show.
Well, thanks for having me, Dan. It's always fun to catch up and fun to talk about real estate. So I'm glad to be here.
Yeah, you bet. I enjoy your company. So why don't you start off by sharing maybe a little bit about your background, Nick? What did you do before you got into multifamily, and what led you down the multifamily path?
Well, I wish I had some really cool story, but I have been in multifamily for 20 years, and I literally went to college, Texas A&M, got a marketing undergraduate degree, kind of with an emphasis on the sales side of things, just wanting to work with people and just kind of control your own schedule and where hard work sort of pays off. But I didn't necessarily have a direction I wanted to take that. I did a couple different things in my undergrad, in the summertime and all that, just to get some experience, but still nothing that I was really passionate about. And at the time I thought, well, why not stay and study real estate? And Texas A&M has a really incredible real estate program. And so I said, well, I'll stay through, go ahead and knock this out. And so through that program, really kind of learned what brokerage was. I didn't even know that it was a career path or option, or really didn't know anything about real estate at all, other than seemed like all the late night infomercials were always talking about buying real estate and doing this, doing that. So I thought, well, it sounds interesting. Everybody kind of knows that real estate's where money's made. And so I stayed, learned about brokerage, was recruited actually by Marcus and Millichap because of my sales background in other fields and kind of some real estate expertise through this graduate program. And in 2004, I started here, and I've been here ever since. So it's been a good run.
Wow. So, getting into the brokerage scene as a multifamily, top broker, it takes time. It's not something you just step into, right? Everyone would love to show up and be selling these big deals. What did it take? What was it? What do you think it was about yourself? Because your track record, 3.1 billion in value sold, that's not an average number. What do you think it was, or what did you do to elevate and be a standout?
Yeah, well, it's funny because I really kind of started at an interesting time in the marketplace. And when I say that, I can remember in my first year, instead of now, everybody listening to this, and certainly you guys, y'all get e-blasts and see new deals every single day from brokers from all over the country. When I started, we didn't have anybody's email address, and people would stay after hours and they would type in like 1,000 fax numbers and literally send out like a one-page fax. The fax machine would just literally be going for, a couple hours straight, just sending out a fax to all of these numbers. And so, we were at this kind of inflection point with technology back in, 2004. And so I think that was something that really kind of helped us ramp things up quicker, as just using technology to our advantage, being able to cast a wider net. Marcus and Millichap as a firm has always been kind of on the cutting edge of technology, and always trying to look for different ways to enhance in that aspect of the marketing. And so so that helped just sort of get more deals. It was something unique that we were doing, being able to send out early e-blasts. We were also the guy that hired me had this mindset of, hey, let's kind of create a team. And really at that point in time, that was not a common thing. There were a lot of individual guys, but there weren't really teams as you see today, kind of left and right. And so it was just a lot of things sort of coming together. The other thing that's kind of funny is I mean, I'm wearing a headset right now just because it, blocks out the noise and keeps me from getting distracted too easily. But, back then we had headsets that had a big old cord hanging from them that plugged directly into our phone. Nobody had a GPS. We bought a GPS when people didn't even know what GPS was, and it was about the size of certainly, there was no iPhone, so it was like a little miniature box, and had a little beanbag under it, and you plopped it on your dash and plugged it into your cigarette lighter, and all of a sudden, instead of trying to use a map to figure out how to get around and look at rent comps and look at deals, we were able to pop a number in there, and it'd take us right to it. We thought it was the coolest thing we'd ever seen. We're like, oh my gosh, this is amazing. And it was just so normal now to receive e-blast and to look at split screen monitors and to have a GPS to get around. But back then it wasn't, and so it really allowed us to kind of accelerate our growth and working in a team and creating some synergies there. We were ahead of our time. Now, when you talk about doing multiple billions of dollars of transactions, the craziest part about that is, as you know, deals back then were way cheaper than they are today. And so, deals that might sell for 150,000 a door today were 30,000 a door back then. So that helps get your career sales volume up when deals go up 4 or 5 times in value over a 20-year period of time as well. And certainly we've had some deals that we've sold 3, 4, 5 times over the years, and all at higher prices than what we sold them at previously. So that's been a big part of the growth too.
Yeah, you bring up a good point, and a lot of time I get the question from folks, where do you guys find these deals? How are you bringing these deals to your investors, and how do you win these deals? And 95% of our purchases come from brokers just like yourself. You guys control the market and build these relationships with owners. And when we buy something from you guys, when we bring it back to sell, we sell with you guys. So it's almost like the deal is kind of like a Marcus and Millichap deal, if you will. And, I think you have people that hear that and like, why would you do that? But the piece that's valuable is the relationships and keeping those relationships on the right plane to build that trust. And so if you're listening right now and you're wondering, hey, how are you guys sourcing deals? They're all through broker relationships. And it goes both ways. I think that the brokers build trust with you as a buyer based on you doing what you say you're going to do, and you lean on them to go and get you your best price when you're exiting. And so do you want to talk about that at all, Nick? I mean, what level of importance is that to you guys when you're awarding a deal, especially in a market like this?
Yeah, well, I mean, I think it's incredibly important for us because I have 20,000 people plus in my database, right? And so when I call you, Dan, or Mike, or anyone on your team and say, "Hey guys, this is a deal you guys need to look at," I think it's important for whoever's receiving that call to realize that call could have gone to someone else. And so if I'm able to show you a deal and you're able to take it and make money, and first of all, win the deal in a market that's really, really competitive. And the DFW market is certainly a top 5 market in terms of competition over the last decade. And specifically, 3, 4, 5 years ago, I mean, it was just the competition level is incredible. So if you're able to actually win a deal, you won the deal because the broker was helping you win a deal. That's just plain and simple the case, because there likely were 10 other people that could have been awarded that deal. And so you certainly didn't win it without an assist from the broker. So if you win the deal and you execute a business plan and you make money for your partners, I think it's important that the broker is rewarded on the back end for bringing you that opportunity, right? And if they aren't, of course, like anything, it's like, okay, well, maybe you're not valuing the relationship as much as I'm valuing the relationship. And so I think if we're really a team and going to try to grow, and this business for me, I've been doing it now, like I said, for 20 years. It's not about one transaction; it's about a bunch of transactions. And so with you guys, we sold you that first deal. We sold it for you when you brought it full cycle. Sold you a deal in New Mexico. We're going to sell it for you, and because of our friendship that we developed over the years, we've invested with you as LPs in deals, and so that's awesome. And then we just did another transaction in Dallas in December that we closed on. So that's what it's all about for us. Now, of course, you have a fiduciary to your partners, and you want to make sure you maximize sales proceeds, and we totally get that and understand that. But a big brokerage shop like ours is going to do that for you, and so that you don't have to worry about that when you're doing deals with big shops with national exposure and national presence, and so that's how these deals are really win-wins.
Yeah, man, a little story for you guys. As we were looking to get into the Dallas Fort Worth market back in 2017, 2018, we were aggressively underwriting deals and making offers. And we probably made 15 offers and just got denied on every one of them. And we made a bunch of offers with Nick. You are, I think, the first group we started really consistently submitting offers with. And something happened where we were awarded a deal after a lot of failure, and that deal was awarded, and then the buyer decided, hey, I'm selling a portfolio, I'm going to keep one and I'm going to sell the other one, sorry. And I remember you called, and I still remember the feeling, being like, sorry dudes, this deal's not going to happen, they're not going to sell it. And at that point I could feel you too, Nick. You felt bad, like deep down you're like, dude, I've been working with these guys to bring them into the industry to actually win a deal. Here we won something, and then the seller decided, I'm only going to sell one of the two with the portfolio split. And that point, I think when you said, hey, we're going to continue to work and we're going to find something, I believed in that. And then, 2-3 months later, that's when our first deal was landed in Dallas. And it was a smaller 86 unit deal, south of Fort Worth, in a little town called Cleburne. And the deal was just a home run. And so I think that one thing I want you guys to hear, if you're listening to this, is be persistent, and you gotta stay at it and be your word. Like that's the one thing that it seems to me like you have when people try and work to get into the industry, they don't stick around long enough, and or don't develop the relationships and the trust to get a chance to swing. And when you are ready to swing, you got to be able to perform. So it's a challenging business to get in, but once you get in, and I think about Mike Becker all the time, he says it's an unfair business. Totally true. In the beginning, it's difficult to get in, but as you get in and as you build the relationships and trust goes up, deals come to you much easier. So, be persistent, hang in there. I want to discuss a little bit, Nick, with you about the DFW market as a whole. What we saw in 2021, 2022, the pricing come up, and now obviously we're in a multifamily real estate recession pullback. What do you see happening in 2024, specifically in Dallas, Fort Worth, with asset prices, valuations, cap rates?
Yeah, I mean, I think it's challenging. We've actually just launched a few deals here in the last week or two, and actually, you and I spoke before we started recording today about another deal coming soon. So I mean, there are deals that are going to happen, that have to happen, that need to happen for various reasons. I think where the challenge is right now is people who buy multifamily know when rates rise, interest rates rise, cap rates rise. It makes sense if you are paying more to service your debt, you have to buy a property for less in order for the math to work. And so the higher the cap rate, the lower the purchase price. So I think what's happened is when, we did a lot of transactions when interest rates were in the low threes, mid threes, high threes, and cap rate, and with 2, 3, 4, 5 years interest only. And, that math worked great. And what we've seen is an unprecedented run up in rates, and that nobody anticipated. And so fast forward when you have short-term bridge loans with a 2-year term, a 3-year term, and people are now at the point where they need to refinance or do something, and again, you could be the smartest investor in the world. And I mean, there are a lot of really, really smart, savvy people that are all in this exact same position. This wasn't a big mistake that someone made, or I can't believe you did this. This is what everyone was doing, including the most seasoned owners and operators out there. But when rates are now double, in some cases, what they were 2.5 years ago, and that math doesn't really work that well. And so that's what we're kind of dealing with right now. Is there's a lot of people trying to figure out, hey, do I just take the loss and move on? Do I extend and figure out a way to kick the can down the road until interest rates come back down and therefore cap rates come back down? What's the right play here, right? And so, and there's all different sorts of opinions and thoughts about that. But that's what we're sorting through right now. Our activity is really strong on the deals that we have out. There's a lot of interest. There's a lot of people looking. There's a lot of people that would love to buy deals. There's a lot fewer that actually do make sense, though, and so that's where we were doing 70, 80 deals a year, we might do 30, 35, 40, this year, which is actually a very large number of deals relative to most out there. But it just, you feel like you're doing three times the work for one third of the income, and that's just the way it is right now. Now that being said, guys like you and Mike who are actively out looking to get deals done, it's harder right now, right? The debt's not as attractive. Equity is hard. These LPs out there who, and I'm an LP in a whole bunch of deals, normally I've got deals that are selling every month or two, that I'm an LP in. When the market was fast and furious, you're just constantly churning your money. And never did I have a time where something wasn't in escrow that's being sold. Well, right now, there's just so much fewer deals being sold that LPs aren't recycling their money as much, and they're, the ones that have some liquidity are nervous about it. So those are the challenges, then the headwinds that we're facing in DFW. The good news is people want to be in DFW. They like the way that this is a landlord-friendly state. They like the business environment here. They like the cost of living here. Population growth, job growth, companies are relocating here. There's so many good things, fundamentally speaking, about Dallas. And in fact, if you look at the Marcus and Millichap National Research Report, which is published every year in January, that has Dallas ranked in 2024 as the number one apartment market in the country. So it's a challenging apartment market, but if you're invested somewhere and you're wondering, hey, how do I stack up? Then Dallas is a great place to be invested, and you should feel really good about having money parked here right now, even if you have some short-term hiccups.
Yeah, when you say, that's great data. I did not hear and read that Dallas is the number one multifamily market in the nation for.
Well, and the head of our research department, John Chang, who's just a brilliant guy. I mean, I literally, I know him well, and I've known him for a long time, and I give him grief every single year about ranking Dallas too low. I'm like, no, these people are coming from all over the country saying, oh, I'm dying to get in Dallas, and and every single year, we have a laugh about it, and he's like, well, you got all this new construction, but the algorithms don't like the new construction that we always have. And I said, well, that's because everybody's moving here. We have to have new construction to keep up. But he plopped down next to me at NMHC this year and said, hey, open this apartment market report. And he finally said, hey, Dallas, finally you're number one. So anyway, yeah, it's the place to be. It's a great place to be in the coming years. I mean, I don't see any sort of headwinds there. I mean, we're delivering a ton of new inventory this year, but even despite that, we're still in a much better spot relative to the rest of the country.
Yeah, and you said it's a challenging market. What types of challenges are you referring to when you say that?
Yeah, I mean, I think it all kind of trickles down. There's a relationship between new construction, so, and existing inventory. So, you bring 40,000 units online. Well, that's a lot of units to fill up. And again, these people probably have construction loans. Their interest rates have run away on them from when they first started building to now. They need to get these things filled up. They need cash flow as soon as possible. Heavier concessions than what you would normally see because there's an urgency to get bodies in there and get these things filled up. And then therefore their neighbors are like, well, this is brand new and they're giving concessions. So now we've got to respond. And that just has a trickle down effect to the rest of these little submarkets where these deals are in. And so again, it's short term in nature, but it's something that all these owners and operators have to deal with. Now, Class C may be less affected, but 80s and newer is certainly being affected operationally as things are more expensive. And then again, this isn't a Texas problem; this is a national problem. But as inflation, has raged, everything's more expensive, and so people a lot of times are trying to figure out ways to cut back. And so sometimes that means I'm a little delinquent on my rent. Sometimes it means I'm going to move out and go get a roommate. And so we've seen occupancy go down a little bit. We've seen delinquency go up a little bit, and then that combined with the variable rate loans, the cost to service that debt has gone up. And so it's not a great formula right now. But again, these are primarily capital stack problems. These aren't really for the most part, they're not operation problems. There's a little bit of operational pain, but more than anything in DFW, these are debt problems, capital stack problems. They're not long-term fundamental issues, but because you got both things kind of going at once, it makes for some interesting times, and you don't feel good about any transaction until it's across the finish line. Unless I'm
Yeah.
selling it to you guys because you guys performed really well in the midst of all this.
Yeah, we appreciate that. Yeah. So, I mean, the other piece that's big is property tax and insurance as well. These variables that you underwrite and you project what's coming, and then you may be off by 100% of your calculation. I mean, that's a big miss. That can really affect your cash flow. So, there
Yeah,
are a
so I'm
lot
seeing
of
a little bit
variables.
of insurance relief finally in the last month.
Okay.
I've had from these deals that we've brought out, we've gotten some quotes, and I've been pleasantly surprised by some of them. So that I do feel like is there's some new carriers that are entering the market. That number is coming down. It's a big deal though, and it's out of your control. So there's not a whole lot that you can do to affect what that number is, other than geographically where you buy. But if you're like, hey, I want to be in Dallas, like, it is what it is. There's X number of carriers, and one of them is going to have to provide you with insurance that your lender is happy with. And so there's not a lot of levers you can push and pull there. And same with property taxes. There's just not as many ways that you can affect that other than hiring a good property tax consultant. Now, we do a lot of deals in Oklahoma as well, and their taxes are incredibly cheap, and they are limited to how much they go up every year. And so some people find that to be really appealing. I actually own a deal in Oklahoma, and that is the best part of it, is that you don't get your reassessment notice every year and cringe because you're worried to open it, and you're like, hey, how long is this process of fighting this going to last? It's very easy, it's very straightforward. You already know your worst case scenario, and the best case scenario might be that you don't move at all. So yeah, there are interesting things, and there's trade-offs because they don't have the robust population growth and income growth that we have here. So you're just that's part of the art of this business. There's some things that are kind of a science. Hey, we're going to do this, and it's going to result in this happening. And then there's other little pieces of this business that you have to be mindful and thoughtful of. And there's ways to add value, and there's areas you can go add value, and there's just different ways to think about certain metrics that could be really favorable. And you guys are a good picture of that. You've owned in New Mexico, you've owned in Tennessee, you've owned in Texas, you've owned in some other markets. So you see how these different areas, they have different pros and cons to them, and in a lot of ways that's great for LPs to have some diversification across some different geographies.
Yeah, I think it's interesting to go back to 2021 and early 2022 with the very clear peak in pricing. And you think about then every deals were getting done left and right at peak pricing, super high leverage, variable rate debt. And now here we are, 2.5 years later, and pricing has come down 20 to 30, 40%, low leverage, fixed debt, and it's difficult to make deals work. And my thought process goes is that if you could make deals work back in 2021 and 2022, and you can't make deals work now, what's wrong with what's going on? Because if I could go back, we wouldn't have bought a couple deals in 2022. Straight up, I wouldn't have bought them. We would have passed and sidelined and be ready to go now. And I think that the window to buy now, with everything Nick just laid out, you're in a position where debt is low, leverage is low. So you have to make a deal work with low leverage fixed debt. Now, if you're a variable rate person, you want to get in and out quickly, that may be a challenge for your business model. But the low leverage debt, you have high taxes, high insurance, you have a ton of cap rate rising and pricing coming down. So from my perspective, it seems like if you know what you're doing in the right submarkets, the right deals, this is the time we've been waiting for. This is the time that has been the best time to buy at greatly discounted prices since probably the Great Recession or 2012 to 2015. So I'm personally excited. And that doesn't mean just go buy anything. Of course, you got to see the opportunity, and it's nice to have some history with some other deals and to be able to take some really good data to underwrite. But what are your thoughts on that, Nick?
Yeah, no, I it's it's a common thing that I ask people. I say, hey, which would you rather? Would you rather buy a four cap deal with a 3.75% interest rate? Or would you rather buy 6.5 cap deal with a 6.25 interest rate? Of course, everybody says, "Oh, I want the higher cap rate deal." And I'm like, "Well, then where are you right now?" Like it's incredible that and again, I get it. LPs are harder to come by right now. Equity is harder to come by right now. So it is more challenging right now than it was when the interest rates were really low. Money was flowing. Even if it should have been flowing less, in hindsight, it was flowing fast and furious. And so many syndicators are like, hey, the bigger the better. Go give me a 40, $50 million deal. Doesn't matter. I can go raise 20 million bucks in my sleep. Versus now, you have deals that the yields and the returns are, for the deals that are trading are probably similar. They might even be a little bit less than they were then, but you're also buying these deals at like a 25% discount over what they would have traded for, a few years ago with yields that are essentially the same. So you're getting a massive basis discount and yields that are still fairly similar because the cap rate's been adjusted accordingly. Now, I think there are two kind of primary type of buyers in the market. One is a yield buyer, and one is an equity multiple buyer. And I say buyer, I really mean LPs. So you get LPs that are like, man, I just bring me a cash flow deal. I want cash flow. And that's, there's nothing wrong with that. Everybody likes cash flow. I personally am a basis guy. I'm an equity multiple guy. I want to give you, a couple 100,000 and 4 or 5 years. I want you to give me back as much as possible. And if that's in the form of cash flow, I'm happy with that. And if it's in the form of we bought it at a crazy low number and we put a bunch of money back into the deal and you sold it for a big pop when rates calm down, I'm great with that too. In fact, I just want the biggest equity multiple possible. And to me, this time that we're in right now is the best time for an equity multiple, probably early years in the run up to to the Great Recession. There were definitely good buys there, but I think when people say who's going to be the winner when we fast forward 2 or 3 years, it's going to be the people that scratched and clawed and tried to figure out a way to get these deals done in this chaotic time. And so again, gets guys like you and Mike who are up for the challenge, and you're seeing the success. You bought deals. The deal I sold you in December, I know for a fact would have sold for $6, $7, $8 million higher than what you paid for it if we could rewind 18 months prior. And so the guy and look, it wasn't it's hard to raise that much equity. That was a big raise in the midst of the market we were in, and you guys figured out a way to get it done, and you're going to end up hitting a grand slam on the deal. And so I think that's who the ultimate winners are going to be here. But again, the scared investor out there, it's just easier to stay on the sideline. And so that's what's happening. I mean, they're scared they can't raise the equity. They're scared that the timing's not right. They're scared of these things. But I mean, historically speaking, the people that are active in this type of market are going to come out really strong on the other side. And there's no way you're not, because one thing we know for a fact is deals are being bought at deep discounts right now, and the interest rates are going to go back down. We know both of those things are going to either happening right now and they're going to happen, and those are the two best metrics that people could be monitoring right now. So anyway, it's an interesting time. I'm personally very excited and have invested heavily in the last couple of years, or in the last 18 months, just with trusted clients, because I think these are going to be the best deals that we've seen in a long time.
Yeah. Well, how many offers are you guys seeing on properties right now, on assets that you guys are releasing? And what do you see moving forward over the next 12 months?
Yeah, I mean, it's interesting. Some deals, what's funny is, from a broker standpoint, a lot of times, again, brokers were excited because it's like, hey, we could slam these 30, 40, $50 million deals together fairly easily, like a couple of years ago, even with, again, private syndicators, which was unheard of. If you fast forwarded or rewound till 2004, 2005, 2006, when I first started, it was like, 130 units was a big deal back then. It felt like it was like, oh man, this is a significantly smaller buyer pool, right? And then over time, it's just morphed into people finding a way to pool more money, be a part of different investor groups, et cetera. And that's really grown a lot, and grown syndicators and networking events and all that kind of stuff. Now we're kind of back to the point of the smaller deals are kind of a little sexier again than they were before. So these kind of sub 20 million, sub $15 million deals, all of a sudden, those deals get a ton of action because people are still wanting to buy deals, but they're scared of the equity. But if they can figure out the equity, then and get a good cap rate, then yeah, there's good interest in that. So I would say on those deals, we still are probably getting double digit offers. They're not as aggressive as they were, but most of the time the winner still has hard money and still has a pretty tight timeline. But the deal that's getting 10 offers now might have had 25, 30 offers, in a better market. So I would certainly say it's down 60, 70% offer activity or credible offer activity from maybe where it was at the peak, but doesn't mean that there are definitely people that are trying to be opportunistic out there. It doesn't mean that people are just are completely ignoring these deals. There's just not as many coming to the table. And again, most of those are people that would have gone out and raised money before, and are just less confident they can do it right now.
Yeah, yeah. What do you foresee values and cap rates doing, let's say moving forward over the next 12 to 24 months? And what are you hearing regarding institutions coming back into being a buyer in the market?
Well, I mean, I think it all starts with some Fed movement, with rates, and it was like, hey, we expect to have several rate cuts, and then it was we expect to have a couple of rate cuts, and now we may not have any rate cuts this year. It's like you just what our enemy is uncertainty. We can live with the higher rates. We can adjust to higher rates. It's when they're bouncing around all over the place that we really have issues. And so, like for you and I, when we were doing our deal in December, right? Really, I guess October, because that's when you guys were rate locking right away. I mean, I remember us texting in the evening and in the early morning. It's like, oh my gosh, did you see what the 10-year was doing today? It's up 15 basis points. It's up 12. Oh, it went down today. And it was like, oh my goodness, like we were riding an emotional roller coaster because there's a lot at stake. That's a lot of loan proceeds. It's a lot of cash flow. There's a lot of things that does. And so, it's like, again, we can live with it as long as it's steady and predictable. But so I think as we start really feeling confident rates are going to come down in the nearer future, that'll help open things up again. I think institutions are, and look, that's not who my client typically is. I certainly know some guys that are kind of in that space, but that's not generally who our client is. But most of those guys, they're going to get fired if they make a mistake. They're not going to get fired if they don't do anything. It's like, okay, the easier thing would just be, hey, we're going to sit it out. It's too volatile, versus getting real bullish and going in and trying to get real aggressive. It's just not an institutional mindset of going in and being really aggressive. They don't need to, and it doesn't really fit their model. So I think there's dollars there and they want to come back in, but I don't think that's imminent until we see a little bit more relief. Unless it's just a killer deal, which those are out there. But I think cap rates are fairly steady for now and maybe for the next 6 months or so. And then I think at some point they'll start ticking back down again. And then, so in the next 12 months from today, I certainly expect cap rates to be lower than they are at 50 basis points lower, hopefully, maybe a little bit more, maybe a little bit less. I mean, who knows? But and then 24 months, I think even more than that. Will they get back to where they were 2 or 3 years ago? I don't know. I mean, historically speaking, we come back stronger than we were beforehand. I mean, if you go look at values on a chart for the last 50 years, you know you're going to see that the number just keeps the values just keep getting higher and higher and higher and higher and higher. So I mean, I do think that's likely to happen at some point. Values, even if you bought a deal and you bought it at the peak of the market, you may have to wait it out for a while. But if you have patient equity and the right debt, I think you'll probably be able to get out just fine. So we'll
Yeah.
see. I
Yeah.
mean, the thing is construction's not getting any cheaper. we know construction costs are going to keep going up, and so the only way to make that work is for rents to keep going up. It's just kind of an interesting thing when you think about it. They're going to stop building because they can't get the math to work, or which I think is very unlikely, or they're going to keep building. The math will work, and then other people that are not quite as nice as those deals are going to be able to keep pushing their rents, and everything keeps rolling forward.
Yeah, yeah. I mean, I heard patient equity and the right debt for this time, ladies and gentlemen. So keep that in mind. What do you think the response is going to be like from investors when rates actually start to go down in the future? Do you think it'll just be this wildfire, we're back, or do you think it'll be a slower rise?
I think there's a lot of pent-up demand. I think a lot of people are chomping at. I mean, they would love to be out doing stuff. Like I said, it's if they had the equity, I think there's a lot of groups that would be more eager to get out there. But because this is different than what they've experienced, and if you just watch the news and read the news, it's a lot of negativity that I think that they're just sitting there. So I do think you'll see a flurry when we start getting some relief. Now you may see a bunch of deals that all hit too, and so the deals may hit at a greater rate than the demand goes up from the investment community, and that could be short-term problematic as well. We thought we might see a flood of deals at the start of this year, and that just these lenders have generally worked with these investors, and so we haven't seen the flood of deals that we thought we would. So yeah, it'll be interesting. I think there's a lot of people that are very, very hungry to get back out there and trying to line things up so that they can make a splash when the timing is right. But I don't know how they're going to determine that timing is right, other than people saying, "Hey, when are we going to buy a deal? Let's get back out there."
Yeah. What advice do you have for investors just, looking to get started within real estate investing, or even for the investor that has more experience? Yeah.
Yeah, well, I think the advice for the person getting started is you need to do a deal. I mean, even if it's a small deal, that's great. If you want to do a deal as an LP, that's great. That's a different type of experience than owning a deal yourself as a GP, or just outright on a smaller deal. So but I would always encourage people, take that first step. Be thoughtful, get the right team, get a mentor or somebody that that's bought some larger stuff to be able to give you some advice on hey, how do I structure this? And how's my underwriting look? Am I making any obvious mistakes here? If you have an expense ratio of 30%, yeah, you're making a mistake, because it's not going to be 30%, and so I think those are things that somebody should get out and do. I think for the investor that's nervous right now, I've got clients that do own 30, 40, $50 million deals, and they're like, hey, I am nervous right now, so I'm just going to go buy a $15 million deal right now. I'm going to go buy a $12 million deal right now. I'm going to keep doing deals just on a smaller scale. And this isn't my long-term plan, but why not, right? Like you just said yourself, that y'all's Northridge Court deal was an absolute grand slam, right? That was a sub 100 unit deal. Probably if I called you with it today, you would be less excited about it because you want to do something bigger, and you guys can actually get bigger stuff done. So that's wonderful. But I think those kind of deals, nobody's ever going to go broke making money, right? So keep doing deals, even if they're not as big of home runs as you'd like for them to be. There's nothing wrong with a solo home run. It's not as good as a 3-run home run, but still keep tacking on wins, and good things are going to happen. So I keep encouraging clients, and I'm like, hey, why don't you? I mean, this is a killer deal. I know it's a little smaller than you want, but you should dig into this. You should look at this, because I know for a fact this is going to be a winner 3 years from now, 4 years from now, 5 years from now. So that would be my biggest advice. Just don't sit around. I mean, you're going to miss the greatest opportunity to buy that we've seen in the last decade, because something's not fitting into the perfect little box that you had drawn up. And so be active, go out there, make something happen.
Yeah, I could not agree more. I think about Warren Buffett's line, when others are fearful, be greedy. And
100%.
I think if there's a time to be greedy, it'd be now with the right underwriting, with the right team, with the right debt, with the right exit strategy. Thank you so much, Nick, for joining us on our show today. If we have any listeners that want to reach out to you, what's the best way for them to contact you?
Yeah, well, you can certainly find our contact info on our website, which is multifamilyadvisors.com, and that's the best way to. You can see our inventory, you can read about us, our team, and then it's got all of our contact info on there. So again, that's multifamilyadvisors.com. And look, we'd love to have conversation with anybody who's interested in talking, and just give a little final color, just so that the listeners know, our team is set up to literally work with investors on their first deal, all the way to investors that are buying huge deals, and all the way, we have a 75 unit under team. We have guys that cover the bigger deals in Dallas, and then we have a very large secondary markets team. And so, again, there's something for everyone here, and we would love to take those calls and help folks start to get into the apartment business.
Yeah, I couldn't agree more, you guys. Nick and his team helped us get into the Dallas Fort Worth market, and the rest has been history. So reach out, build that relationship, get on some tours, start submitting offers that make sense, and you can buy some really great deals in the Dallas Fort Worth market. So thank you, Nick, again for coming on, and thank you so much for tuning in to another episode of Keeping It Real Estate. If you haven't already, make sure to visit our website and fill out our Contact Us form, just to ensure that we can keep you up to date with important real estate news as well as future opportunities. Thank you so much. We'll see you on the next episode.